Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're already counting down to the next VRIC, January 21st and 22nd, 2024. And today's guest is an author and the chief market strategist of the technicaltraders.com with over 25 years of experience in the markets. It's Mr. Chris Vermeulen. Great to see you.
Hey, thanks for having me, Jesse.
Yeah, thanks for being on the show. I want to get started with your trading and investing strategy because it is very unique. I heard you talking about it in a recent interview with David Lynn, and it intrigued me. So, could you break down your trading strategy, what instruments you trade, along with your typical time horizon?
Sure. Yeah. I trade a fairly unique strategy, but it's based around one core thing, which is around technical analysis. So you could say I'm a technical analyst. I could care less about politics, news. I don't listen to it. I don't follow it. I generally don't know what's going on. My 10 and 13-year-old kids usually tell me if there's breaking news. So I follow price. All we care as traders and investors, if price is going up, we want to be long and we want to manage our risk. If it's going down, we want to profit from it or at least find something else that is going up. So I just pure price action oriented. I would say my time frame is like swing trading, position trading. So our trades will last usually a few weeks to potentially like 8 months or so. And I like to really only use ETFs. So I've done the whole gambit. I've done stocks and micro caps and forex and futures and options, you name it. And I found my sweet spot for my personality, the waves that my brain sees in the markets. My type of analysis is really good for trading ETFs. I like the indexes. I like precious metals. I like treasury bonds. I like the US dollar index. So I like to look for things that are really liquid. I like to more or less play the market. I think of it as like the ocean. There's tides. And if you're a surfer, you're always waiting for a nice set of waves to roll in every 5 minutes. And so I look for those sets. I avoid the chop, the little wiggles and the news driven pops and drops. And I wait for these beautiful kind of wave-like patterns that happen repeatedly in these big asset classes. And I just take an ETF position in that asset class, like the NASDAQ, for example, US equities, or treasury bonds, TLT, the ETF. So I only focus on holding the best asset at any given time. And sometimes cash is the best position. So that's kind of how I rotate through that. And more or less, I call it asset revesting. So instead of the buy and hold, I focus on more or less really just looking to rotate my capital, reinvest it in the best asset at any given time. And, if I share my screen real quick, I can show you kind of a visual. So let me show you a couple charts here. So this here is the weekly chart of the SP 500, the SPY ETF. And I like to look at the ocean or the market like the ocean. And when we've got green bars and we've got a buy signal, we're looking at the tide going up. And when the stock market goes up, we typically see almost all assets go up with it. So if you know if the market is going up, then you can focus on what are the best assets within that kind of market to get involved. When we get a sell signal like we had over here, you really don't want to be involved in the equities market, or you want to be looking at strategies that profit from falling prices. And we're back onto another buy signal. Now, this is kind of the long-term view. This is telling us if the tide's going up or down. Then I like to drop down to the shorter-term time frame. And when the tide is going up, we want to be aggressive and play these strong rallies to the upside. We want to be in cash or look for different investments when the market's chopping sideways. For example, the market could be going sideways or down, and we could move into bonds. We could move into the US dollar ETF, whether it's rising or falling. There's an inverse ETF. During COVID, we rotated out of stocks near the top. We got into bonds. We caught a 19% rally in about 9 days. And then we waited for the next buy signal and we rode the market up. So this is how the market works. And right now we're in this kind of major topping phase in the stock market, a stage 3 topping phase, which if I was to show you a quick visual of that, there's 4 stages that the market goes in. There's a stage 1 base, a stage 2 bull market. Stage 3 is a topping phase, very dangerous, which is why it's labeled red here. And then a stage 4 decline, which is a financial reset. 2008 financial collapse, 2000 tech bubble. We're coming into potentially another one of these. And so we got to be really aware that we're in this complacency stage where people are thinking 2022 was the bear market. It was over. It's over. But we could be going into something much deeper, and people just need to be aware of that. So my strategy is based around stepping to the side if something's falling or moving to an asset that is going up. And I call that asset revesting because we're constantly reinvesting into different assets. That's it from a kind of a high level there.
So, you've obviously have a ton of experience in the markets. You just mentioned asset revesting, as we can see in the background there. You've recently released a book on the subject. I'm wondering, for your average retail investor who wants to up their game, spend some more time with investing, would you recommend they try a strategy like this? How much time does a person have to put in to be able to spot these trends and be able to take advantage of them? How much training, how much education? Is there a subset of investors, those who don't have enough time, who should be going by the old adage of stay long the market for years or even decades? What's your thoughts there?
Yeah, there's a bunch of good questions packed in there. So I would say if you're an investor 45 plus, I would say the buy and hold strategy is the wrong one to be in. We could be going into a multi-year recession. It could take 3 to 15 years to recuperate from what potentially could be just around the corner. We're already a year and a half into a recession and markets are down. And really, if you're 45 plus, you're getting close. You can taste retirement. You can see it. A lot of people, if you're already in retirement, the last thing you want to do is have the buy and hold strategy because you have no idea what's going to happen. And if you do the buy and hold strategy, you fall victim to a bunch of different things. You fall victim to drawdowns. There's two types of drawdowns that are like silent killers, I call them. Drawdown is obviously your account is getting drawn down in value as the market corrects. And then there's a drawdown of time. So the average, bear market will delay your retirement 3 to 7 years. You won't be making money again. And if you are retired, now you fall victim to the second worst retirement killer, which is sequence of risk return. And that means you're withdrawing money when it's drawn down in value. And when the market recovers, you never fully recover. And this is the problem, how most people, there was a survey done. They say 40% of households retire, eventually end up bankrupt or they go broke in retirement. And then another report shows that 81% of individuals run out of money before they die. That is a huge number. And it's all because, to me, the buy and hold strategy. You are delaying your retirement. You have to withdraw through these drawdowns to support your retirement. And it's a big killer. So I would say for the average investor, asset revesting, I built it so that I designed the strategy so you can do it with almost no time commitment. There's two ways you can do it. Either you can learn it and do it yourself, or you can follow a signal service, something like I do, right? I say exactly, buy this ETF with this much of an allocation of your portfolio, and you can follow those trades. And if you're somebody who values the idea, but just doesn't have the time, I actually provide at no additional cost auto trading. So it can automatically be executed in your retirement account. That's what, so many people do, 130 different countries, investors, and myself. I built this for myself. This is for large capital. If you've got a lot of wealth, you're close to retirement, you want to protect it and keep growing it, this is it. We literally grow at more than 2 times the rate of the buy and hold. And the max loss or drawdown we've had is less than 6% because we just rotate. When the technicals roll over, we're like, we're out. Put me somewhere else or just let me sit in cash. And cash is a great spot. We're collecting 5% interest just sitting in cash. So our account is still growing even when we're risk-free from the market. So I would just say, look into asset revesting. There's a website, revesting.com. They can learn all about it. The book is a great way to get on the right page and be in sync with proper expectations of the markets. The, buy and hold is a great strategy for somebody 20 years, maybe 45, because you've got lots of time and you're not on that crunch and you don't taste retirement or you're not living retirement. But as soon as you get above 45, the last thing you want to do is delay or watch your wealth get cut in half in a few years and then, take forever to come back. So that's why I created this strategy. Protect capital, number one, and the profits take care of themselves. That's the nice thing about it.
Very interesting. I would like to go through some commodities with you now, because that's very much obviously the focus of this channel, the Vancouver Resource Investment Conference. Before we dive into the specifics, I'm wondering if you ascribe to the theory, which I've heard from several people up until now, that we're on the verge of a commodities super cycle, that we're going to see a deep correction in the broad market, a market crash, kind of similar to what you were showing in that chart earlier, and commodities will respond inversely. Maybe not at first, maybe they'll crash along with the broad market at first, but we'll see them as I was talking to Michael Oliver the other day. He was saying that they'll almost be like a new safe haven asset. So I wanted to get your thoughts on that.
Yeah, I totally agree with that. I think we started a commodity super cycle kind of in 2019. I mean, a super cycle within it will last a decade or more. Within it, you can still have these big corrections and big pauses, like we've seen in gold. Had a big rally to 2000, it pulled back to almost 1600. While that is a big pullback within a super cycle, that is just a healthy correction along the way to go a whole lot higher. The monthly chart of gold really kind of shows a good view of that. I've got it here on my chart. And if we take a look at the gold patterns here, you can see we've got gold. It started to break out here out of this stage one basing phase. This is where I wrote a really good article about gold, talking about the big breakout and how we're starting to the next rally, the next major super cycle, which is actually very similar to the super cycle we saw just starting back here in kind of early 2000s. And Eric Sprott actually really liked that article. He talked about it quite a bit, about how it got him really pumped to pick up even more metals, because we're starting this next imminent kind of move here. But this is where the super cycle really started. And, this consolidation that we've got going on right now is nothing more than just a pause before it goes a whole lot higher. The next stop is about 2,700 for gold. But along that way, as you just mentioned, the stock market might go into a correction, a bigger correction. We go into a bear market, stage 4 decline. It naturally pulls most assets down in value. So we could see gold come back down to 1,800, maybe even 1,600, and pierce this low and kind of shake the market out. That is not a bad thing. It's just, I think it's very possible that that could happen. And then the stock market eventually will be getting close to an end of the bear market. Gold, silver miners, and a lot of other commodities, I think too, will be probably the first to rally, just like we saw in 2008 and 2009, and it'll be off to the races. And really, this kind of potential pause and pullback, this bear market that we're going to see, it could be very similar to what we saw, back in 2008. Gold had already started its super cycle, and it pulled back about 34% before, having the next major rally to the upside. And so this area here, this pause and potential pullback, to me is just, it's just part of this next rally to the upside. So I honestly really hope we see gold back down at 1,600. I would love to buy some more physical before it turns around and starts to rocket higher. And when it does start to rocket higher, whether it's late this year or mid next year, who knows how long this takes to unfold, precious metal miners are going to be, one of those plays that if you were involved in the miners anywhere back here in the early, 2000, this phase, I mean, it's unbelievable. It's almost like a once in a lifetime. Not too often you can catch one of these again. And I think that'll be the opportunity going forward next year and beyond. Gold miners, silver miners could be a huge play on top of the physical metals themselves, but it's just going to take a little bit of time, I think, to mature. There's the possibility gold just takes off as a safe haven play. If currencies and banks fall under, people might start stockpiling up more in metals. The general public might get involved and drive metals higher without that correction. So long story short, I'm very bullish on metals. It just might not happen right now, which a lot of people are kind of hoping it's just going to take off and rally. But I think there's a little bit of headwind along the way.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
I wanted to talk about energy and the oil sector specifically. OPEC Plus has announced they're extending supply cuts into 2024. This has caused a bit of a jump in the oil prices. Now, I know you don't necessarily pay attention to that actual news. You're just looking at the technicals. But do you ultimately think we're going higher over the long run? And do you think a recession could bring on enough demand destruction to keep prices suppressed for a longer time frame?
Yeah, so I think crude oil, crude oil topped out back in early 2022, kind of did a double top type of play. What's interesting, just to loop back just a little bit more, what's really interesting about the stock market is there's cycles within it. There's areas here. This blue cycle here is the stock market cycle, and the yellow one is the economic cycle. Now, the stock market tops before the economy, because investors are smart. They can say, hey, I see earnings projections are lower. Obviously, the company's not doing as well. And so people start selling the shares. So the stock market can see into the future and they bet, ahead of time. What's interesting is last year, energy was the leader. It was smoking hot. This year, precious metals and miners have been leading the way. They've had a little weakness over the past month. But these are the two sectors, the last two hoorah kind of push up just before the stock market goes over that kind of major waterfall cliff. So knowing that these are the last two kind of sectors, we go back and look at crude to answer your question. Crude oil's kind of put in this major double top. You could argue this is a huge topping phase. It is very close to potentially starting to break down below $65 a barrel. If we go into a recession, I think we're going to see demand slow. We're going to see shipping slow. I mean, overall, crude oil, I think, will likely kind of pull back and fall back into the 50s and maybe even into the 40s going forward. I know OPEC has talked about tightening things up. It's created a very strong pop in the last 3 days. But I mean, OPEC, they're good at doing that. They can move the price of crude for these pops, but generally news-driven moves are given back within a few days. So all it is just a bunch of people trading and algorithms trading on that news. They create this giant pop and then it'll just fizzle right back out. So I don't think crude, maybe it wants to go a little bit higher, but in the long run, I think by the end of this year, it'll still probably be much lower and could be down in the 50s very easily.
And over the long term, do you think there will eventually be a recovery in oil if it does drop that low? I mean, I think we will need fossil fuels for a long time, and oil inventories are lower from what I've heard from a lot of people. So do you think that trend would eventually reverse should it turn out like that?
I do. I think eventually we'll see crude oil. I think it's still a powerhouse and we still need it. And when the economy's booming, oil's used in so many products. I think it's just going to continue to oscillate, be oversold and overbought. And I mean, just like every other asset, right? I mean, other spaces like uranium stocks, they've been oversold for so long, but they are coming back to life. They could be one of those hidden gem sectors for stocks, next year. I mean, along with gold miners. So I kind of group them together with the miner space. And crude's just a big monster. It just constantly rotates around. And I don't really actively trade crude, but I like to follow it and get a feel for what it's doing. To me, I think it's going to continue to kind of fizzle out. Eventually, I think it'll bottom when precious metals start to bottom. We'll probably start to see commodities rally very well because now, I mean, everybody will be like, okay, well, if the stock market and the economy is actually firming up, that means there's going to be lots of demand for potentially 5, 10, 15 years. There's a lot of upside potential for everything. So that's when we see commodities take off, and energy is definitely a big part of a booming economy.
Well, you gave a great breakdown of gold. I'm wondering if your feelings on silver are the same. Is it the same tailwinds you're seeing? Is there anything different about the setup for silver? And is there any challenges, headwinds facing silver that maybe aren't the same as gold?
Yeah, so if I was to pull up the chart of silver, silver's a little kind of noisy in terms of the chart pattern. It's been all over the place. It has these massive spikes. I mean, when I got kind of involved in metals back in early 2000s, I mean, we all thought it was going to go a whole lot higher. There's the huge short squeeze. We did see a massive rally, but it pretty much is going to follow what gold does. the big disconnect between silver and gold miners compared to gold is, gold is equivalent to trading right up here. It is testing, all-time highs, while silver is down like 30 plus 40%. Gold miners are also down. If I think we were going to see precious metals really rocket higher, we would have been seeing these leverage plays moving way ahead and be up at these levels or much higher. So gold to me is the global safe haven. If you just went to any average Joe who really doesn't know anything about investing and said, if you can't buy stocks or bonds, what are you going to buy? They'd probably say, gold as the next asset that comes to mind. And that's the mentality of a lot of average investors. And gold is a global asset. So it's not just, North Americans interested in gold. It's the whole world as a defensive play. So the headwinds for silver, I think it'll move with gold. I think silver might underperform and get pulled down more with the bear market if we go into a stage 4 decline percentage wise. But once everything does bottom, silver usually plays catch up and far outperforms gold. But you might not want to be holding it or expecting it to go higher right now, because it could still pull back percentage wise pretty sharply over the next 6, 8, 12 months until this stock market, I think has a financial reset and cleanse event.
And what about copper? Because I've heard as well, similar to what you were talking about with the demand for crude potentially experiencing some issues due to a recession. A lot of people are saying similar things with copper. Lobo Tigre notably has mentioned that he's kind of sitting on the sidelines when it comes to copper at the moment, although he's very bullish over the long term, like around a decade. So what are you seeing in the charts for copper?
Yeah. So again, copper falls into the super cycle commodity. I think it's going to continue to have big demand long term. I think we're going to see commodities just keep going up and up. I think that's just the natural tendency for most assets in general. But you look back here at 2008 when we had a 70% correction in copper during the last stage 4 decline. So nothing is immune. Copper is also it's big into home construction, copper wire. And of course, that was the housing crisis. So it definitely got oversold, and it rebounded with a vengeance and made some new all-time highs. But, silver, you got to be careful. And this is the problem with the buy and hold and diversification. And a lot of people don't realize this is if you just spread your money out everywhere, when we do go into a full-on financial reset where all asset classes actually come down and become fair or equal value or fair value again, real estate goes down, copper goes down, almost everything goes down. So spreading your money out, the buy and hold diversification is a terrible way to, people think they're hedging, but all they're doing is just spreading their money over a bunch of not as good assets, and they're all going to get pulled down in value. And it's the same with people who invest in blue chips and go for dividends. They want to get their 3-5% dividend payment, yet that stock can fall 5% in one day and it wipes out all their gains. In fact, during the COVID crash, the large blue chip dividend ETFs and stocks fell way more than the stock index themselves. And that's because the majority of the money in the stock market is held by people 45 plus. They're loaded with big blue chips because that's what the industry tells them to buy dividend, reinvest, and do all that stuff. And so when they panic, they're all selling the same stocks, the big blue chips, and they fell like 45%. So baby boomers, retirees holding blue chips, dividend stocks, and bonds, they're like the most at risk. They're taking, to me, as one of the worst strategies you could do for the age and the time frame that they have going forward here in the market cycles. So it kind of goes off of copper, a little off track, but you got to be aware. I think copper and commodities are great long term, but we still need this financial reset where copper could be $2.50 in a few months from now, for all we know. And I think it'll be a screaming buy, but there's a lot of pain, I think, across almost all asset classes over the next 6, 8, 12 months. And you just have to be patient, let the market work itself out. And then, you'll have all your capital ready to deploy in the right assets at the right time versus, holding on and waiting years for it to come back just to break even.
So you're an advocate here of just sitting in cash, getting your 5% on your money market account or your T-bills short term, and just waiting for this financial reset. Does that make sense?
Yeah, we're not sitting in cash. We're long the markets. I mean, we just locked in about 10% on our NASDAQ trade for half of our portfolio. So we're long the SP 500 because our asset reinvesting strategy is telling us money's flowing into the market right now. The trend is up. Get on board. So we ride that. And that was the first chart I showed you. When it goes green, we ride that up. So we're long the markets, but I mean, the market only has to roll over 3 or 4%. If the technicals start to break down, our strategy just says, hey, the underlying strength of this market is weakening. Big money is actually exiting positions, and then it will actually exit the position too. And then we'll sit on our hands and look for something else. Bonds might come to life if rates start to fall. Bonds might be one of the best investments actually over the next 12 months if rates start to fall. There's recession, stock market decline, the Fed will start cutting rates potentially, and bonds are going to go skyrocket. So the key is not holding on to assets that are falling in value. You're way better to just step aside, collect interest, and be drooling over the new opportunities of things getting cheaper and cheaper that you can reinvest. Because after a bear market, I mean, the stock market usually rallies 50 to 100% in a few years. And so you can double your wealth by stepping aside, right?
Very astute observations there. I wanted to end on international markets, specifically Japan, because the Nikkei 225 has risen to a 33-year high. So my question is, are the same challenges that are facing the United States economy facing all the countries of the world? Is this a global phenomenon, or could we see a new bull run up ahead in a market like Japan?
Yeah, it's tough. I don't follow Japan too much. I did look at the chart. I don't have it on this charting platform. I don't have that data feed, but we are 33-year highs. You go back far enough. We're getting up to that nosebleed section where it peaked out many years ago. It was like the 60s or 70s. I don't exactly remember where it was. It's definitely in a full-on bull market. It's got a very strong chart. You look at it, on a monthly chart, it just had like a year and a half long pause, and now it's starting that next leg higher. So it could be on fire here for several months and keep going up. I do think, being long the index is great. I think it's in a bull market, but when it does reverse, you don't want to hold it, because the last time it got to this level, it came straight back down. Obviously, it's always a different economic environment, but what goes straight up usually comes straight back down, usually comes down a whole lot quicker. So it's all about protecting positions. And that's the one thing that I always focus on is whatever position we get in, we always know where our first target is, our second target is. We move our protective stops up. So, we can be away from the computer. And if something drastic happens and price falls, we automatically get executed and out of the trade without having to watch the screen. And that's the most important part, is protecting your capital. The first thing we all do when we get into a trade, or at least subscribers and I, is put our protective stop in place. And then at least you can sleep knowing that any piece of news that hits with the debt ceiling lurking around, we're fine. And then you can put in your other orders and manage the position from there. So I think the Nikkei's on fire, and it might continue to scream higher. I think it's getting a lot of attention, and there's money piling into it. And obviously it's way outperforming the US equities market. So money's shifting from US over to that index right now.
Well, thank you so much for joining us today, Chris. A ton of knowledge shared. We really appreciate it. For those who want to learn more, could you tell us about the technicaltraders.com as well as your new book and where people can get it?
Sure. Yeah. Well, at thetechnicaltraders.com, I provide analysis just like you and I did. Every morning at around 9 o'clock, I release a 8 to 10 minute video. I recap the markets, generally not these monthly charts. I'm looking at intraday charts and the daily charts. And we talk about what happened yesterday, what's happening in pre-market, how it's going to affect our positions, and what we're expecting through the day. So you get a nice granular level view of the market. And pretty much every trade that I issue is a trade that I'm putting on in my portfolio. So more or less, I'm trading for me to grow my money, and I share it with everyone else. So my best interest is in growing my capital, and everyone can benefit from following suit. So I'm not just firing off random trades. I'm not just pushing out trades. I do very few trades, not very many. but we do exceptionally well because I want to more so live life rather than sit in front of a computer screen and actively trade all the time. We only have 5 to 12 trades a year. It doesn't sound like much, and it's not much. It is for a passive investor, but overall, you need that many trades to catch those sets of waves through the markets. You want to ride those and step aside, and if you do that, man, you can really compound your growth really well. So that's what I do at thetechnicaltraders.com. And it's all based around my strategy of asset revesting, which is the book I just published. It talks about how we create a hierarchy of assets. So you find the best asset that you love the most. It could be anything. Anybody can make their own hierarchy. I like US equities, the indexes. I like treasury bonds. I like the US dollar index, and then cash. Those are my positions, and they have an inverse or no correlation to each other. So if one's out of favor, another one might not be. And as you go down the hierarchy, their volatility decreases. So as the markets get wilder and wilder, we're moving down to things that move slower and slower and slower, and we're protecting our capital in that regard as well. So that's how I kind of attack the markets and manage my retirement capital.
Great. Well, I'll put a link to thetechnicaltraders.com as well as to the book Asset Revesting on Amazon where people can pick up a copy. Thank you once again for joining us today, Chris.
Hey, thanks, Jesse. It was a pleasure.